Diversify your portfolio. It's the most repeated advice you hear in all of investing, but nobody who says it can tell you how it works or when it stops working. So let's actually answer it. Not with a platitude, but with a model that actually explains the entire thing. Welcome back to Investing Canvas. So today we're going to pull apart the CAPM, and that stands for the Capital Asset Pricing Model. And using it shows exactly why diversification reduces your risk without giving up the return. And just as importantly, where the free lunch eventually runs out. So first, what is CAPM? At its heart, it's one clean equation. The expected return of any asset equals the risk-free rate plus the beta times the market risk premium. So in plain English, you get paid for taking risk, but only a specific kind of risk. And that distinction paints the whole picture. Now, a bit of a warning up front because I'm a systematic investor and I care about what actually works. CAPM is a model. It's built on a perfect world, rational investors, frictionless markets. It was never meant to be used on its own to pick trades, but as a lens for understanding risk and diversification, it's one of the best there is. Every return you earn comes from one of two places, alpha and beta. And beta is the sensitivity to the market. A beta of 1 moves with the market precisely. Above 1, think of high growth tech. You amplify it, the market goes up, you're up more. It's down, you're down more. Below 1, think of a boring utility or a waste management company. You dampen it. So alpha is the bit that the market didn't give you, and that's defined as your edge. If your portfolio is up 20% in a single year and the market fell by 5, that 25% gap is your alpha. It's what you actually did that the index didn't. CAPM splits your risk into two buckets. We have unsystematic risk, which is company specific, say a CEO scandal, a failed product, a factory fire. It hits one stock, whereas systematic risk is market risk, rate hikes, recessions, pandemics. It hits everything at once. And this is the punchline the diversification crowd never explains. You can delete one of these buckets for free, the other you can't. Watch what happens as you add holdings to a portfolio. One stock, you carry all of the company's specific risk. Add a second, an uncorrelated one, and their idiosyncratic risks start cancelling. Add a 10th, a 20th, the company's specific noise washes out almost entirely. But the curve never hits zero. It flattens out to a floor or a level, and that level is systematic risk or market risk. And no amount of diversification removes it all, at least not by buying more of the same market. When the whole market falls, everything you own falls with it. And hold that thought, because there's a way through that level or that floor, and that's when most explanations stop. So diversification isn't magic, it's precise, and it kills the risk that you're not compensated for, company-specific risk, and it leaves you holding only the risk that the market actually pays you to take. But there's a catch, and it's the part people get wrong. That cancelling only happens if your assets don't move together. Two stocks that rise and fall in lockstep. You don't own two things, you own the same bet twice. A diversification only kicks in when the correlation is low. Correlation low, better yet negative. Assets that zig when others zag. This is the whole reason a systematic book like my own runs multiple uncorrelated strategies instead of one. It's not about owning more things, it's about owning things that don't share the same fate. Now here's where most explanations stop and where it gets interesting for a systematic investor. I told you market risk is the floor, the level that you can't diversify away, and that's true, but only if you stay long and only within one market. Break out of that box and the floor or level starts to move. Go back to what actually drives portfolio risk. It's covariance. How your holdings move together. When you total up a portfolio's risk, every pair of assets adds a covariance term. Positive covariance adds risk, whereas negative covariance subtracts it. Say a return stream that reliably rises when your stocks fall doesn't just sit there being low risk. It actively cancels out the rest of your book. So the goal was never just uncorrelated stocks. It's structurally different return streams. Engines driven by completely different forces. Equities are driven by growth, bonds by interest rates, gold by fear and real yields, trend following by momentum across dozens of markets at once. Stack return streams that don't share a driver, and you're no longer diversifying within the market. You're diversifying across the things that move it, that pull the whole portfolio's beta down. And the most direct tool is the one people are most scared of, and that's selling short. A long-only portfolio is always net long the market. It always carries that beta. But a market-neutral book balanced with long and short positions can run a beta of essentially zero. It strips out market risk entirely and leaves you with pure skill, pure alpha, and a strategy that actively goes short as markets roll over, like say trend following, can carry negative beta exactly when you need it. It makes money in the crashes. The industry calls this crisis alpha, and it's the one thing that actually holds when everything else correlates to one. Because that's the honest catch. In a calm market, plenty of things look uncorrelated. In a real crisis though, most of them snap to one and fall together. The streams that survive are the ones that are structurally negative, short exposure, or say trend following, genuine hedges. And that protection isn't always free. Shorts and hedges usually cost a little bit in the good times. You're paying an insurance premium so that market risk isn't just something you sit and take. And that trade-off, giving a little return in the calm to cut your risk in the storm, is the whole reason my own book runs long equity strategies alongside a trend sleeve that can go short. It's not just there to shoot the lights out. It's there so that the market's worst days aren't automatically mine. Now most investors will never run a short book, and they don't have to technically. So let's set the shorting piece aside and go back to the plain long only portfolio. Because even here, staying fully long, how you combine your assets has real power. So put this on a chart and you get one of the most important pitches in finance, and that's the efficient frontier. Every portfolio you could build plotted by its risk on one axis and its expected return on the other. Mix two assets, say stocks and bonds, and you don't just get a straight line between them because they're not perfectly correlated. The blend curves, and the curve blends back on itself. There's a single point, the minimum variance portfolio, the lowest risk mix that you can possibly hold. For a classic stocks and bonds mix, the bottom often sits somewhere around a quarter stocks and 3/4 bonds, surprisingly bond heavy. Everything on the upper part of the curve is efficient, the best return for a given risk. Everything below the minimum variance point is irrational. You'd be taking more risk for less return, and there's always a better portfolio sitting directly above it. Now add a third asset that marches to the beat of its own drum, say a commodity like oil. The whole frontier pushes up and to the left. Up meaning more return and left meaning less risk. Every genuinely uncorrelated asset you add doesn't just change the mix, it improves the entire menu of portfolios available to you. But, and this is where people genuinely fool themselves, it has to be genuinely uncorrelated. Say you own an oil company stock, oil futures, and an energy ETF. On paper, that's 3 different assets, but in reality, one position wearing 3 different costumes. When oil moves, all 3 move together. You've added tickets to your account, not diversification to your portfolio. And you can go too far the other way. Once you're past 20 or 30 uncorrelated holdings, the risk reduction is basically done. The curve flatlines. Every name you add after that barely dents your risk, but it does dilute your returns. Your best ideas get drowned in a sea of average ones. Diversification is a tool, not a religion. You want enough uncorrelated bets to kill company risk and then stop. And one last thing, because I'd be lying by omission otherwise. Everything we just drew assumes a perfect world, that we can actually measure correlation, risk and return. But in the real world, those numbers shift and correlations spike to 1 exactly when you need them not to. In a crash, everything falls together. CAPM gives you the map. It does not give you the territory. Use it to understand why, and then trade the real world with your eyes wide open. So the real answer to diversify your portfolio. Diversification removes the risk that you aren't paid for, company-specific risk, and it only works to the extent that your assets are genuinely uncorrelated. More of the same market can't touch market risk, but structurally different return streams, like negative covariance, and strategies that can go short, can push even market risk down if you're willing to pay a small premium for it. And past a couple of good, decent bets, adding more starts costing you return instead of saving you the risk. Own uncorrelated things, enough to kill the noise. not so many to drown the signal. So if that was useful, please subscribe. This is where I show how systematic investing actually works with real money or real decisions. Thanks for watching, and I'll see you in the next one.